is on the mortgage basics. And we do this every year or so because there's just some information that you will learn that you don't typically think about. But I want you guys to be open to ask any questions too, because we learn better whenever your guys are asking questions in practical applications. So loud when that AC is on, but I know it's important. So we'll appreciate the fact it's off for a few minutes. All right, you guys see on Zoom, you guys are seeing the PowerPoint, correct? Okay.
Yes, we are.
I'm having to look up, you can, okay. I'm having to look at the TV monitor right now because my screen quit working. But you know what, I can fix that so I'm not looking, hang on 1 second. Let me rearrange some things. You can still hear me just fine? Okay, all right. Mortgage basics. So the mortgage loans that we are gonna go over are just your 4 basics. A conventional loan, a non-conventional loan, which typically USDA follows under that umbrella. So we'll touch on USDA, but we're also seeing a lot of other loan programs that are available, like jumbo loans. That is a non-conventional loan program. It's a non-conforming conventional loan. And then you also have a lot of like bank, y'all are hearing bank statement loans. Have y'all heard those? DCR, DCSR loans. So y'all heard those for investors? That's where we're just.
DSCR.
I was doing it backwards. Didn't sound right. Those are loans that we're starting to see available for investors, where you're not even looking at their income. You're not looking at their employment. All you're looking at is, does the house cash flow? That's it. So we're starting to see a lot of those products show back up again. And then FHA and VA. Let me keep this chat open. Actually, Brandy, if you'll just tell me if there's something in chat that I need to be paying attention to or address. It's kind of fun having to do this. All right, so some of the different terms. The reason I have down payment up here as a common term, you guys know what the down payment is, but do you realize that the down payment is based on the purchase price or the appraised value, whichever is less? And I say that because we haven't really had any value issues in the past. However, I'm seeing houses that the comps were done and the houses were priced based on 6-month comps or 9 months comps. Well, if the buyer agrees to pay that price, it's very possible that we're going to have a property that value, because the market's changed. You can't price based on 6 and 9 months comps. I had one situation just recently where the seller agent did not understand why that was not going to work. And the house the buyer truly wanted. And they were putting enough money down that if the house didn't appraise, we could shuffle those numbers around. Well, in that scenario, if the house didn't appraise, then now their down payment is going to be based on that appraised value, and they're still going to have to write a check for the difference between the appraised value and the sales price, right? Down payment, understanding how that down payment is calculated is really important. And then reserves. So reserves, you won't hear much about reserves because it's not like we're sticking them on pre-approval letters and telling you. But reserves are really important, especially if you have that low credit, high debt to income, and high loan to value. We will need reserves. And the reserves are monies left over after all the fees, after the cashier's check is given to the title company. How much money is still in the bank? There are times you guys would be absolutely shocked at the fact that had to save their paycheck, and we had to wait till their paycheck hit the bank just to show enough funds to close, using every penny to their name to get into that house. And in that situation, have no reserves, it may or may not. So knowing that there are times where there has to be money left over in the bank account. And the way that's typically figured is we will look at the principal and interest, taxes and insurance, and determine how many months of the PITI they have left in their bank account. Now, if someone is buying multiple properties or multiple properties, we will have to have a TI of at least 3 months, sometimes 6 months of every property they own, because you don't ever know when one of those properties might be vacant and they have to cover the payments, right? So the reserves really matter, especially if you have a borderline deal. And then debt to income. That's going to become a big deal now, especially on a conventional loan, because pricing is going to be based, the price that they're going to pay for the interest rate is going to be determined by the debt to income. Now, with the new guidelines that we have, what Bill and I were just talking about, the struggles that Brandy and I are going to have is if we don't calculate the income the exact same way an underwriter is going to calculate the income, and the debt to income changes, then it could be the pricing of that interest rate changes. And now the buyer needs more money at closing, and they find out when the file's in underwriting. So we as an office are trying to figure out really what does that mean for us, because it's really going to matter. In how that matters is, in us, as we've talked about how you figure income. So if you have someone that has had, I'll use the same example we were talking about this morning. If you had someone that has had 3 jobs in the last 2 years, I have got to get income verification from all 3 jobs. And if they were making bonus or commission or overtime in any of those jobs, I have to have those broken out. So a W-2 does not break out commission, bonus, overtime. All it gives you is the total income. And so we would have to go in there and get an employment verification with the income verified for each category in which they're paid, compare it to the other jobs that they've had in the last 2 years, and do an average. So if the underwriter disagrees with my average, if they used to get bonus at one job and now they're getting commission at another job, I can't necessarily average it. All I can count is the base pay. But in the last 2 years, base pay has gone up for a lot of people because employers have had to pay people more money to retain them. So then the question is, how is that sustainable? Will that continue to be the case? So if we can prove that that would be the case, then we could do an average over the last 2 years of that base. We could count the new base pay. If the underwriter doesn't feel that's sustainable, or that the file is too risky to take the risk that someone later, everything we do is all of the decisions, the loan decisions that we are making is to make sure that we don't get that loan stuck and on our pipeline with no insurance from Fannie, Freddie, HUD, or whoever is backing that security. And an auditor looks at everything that we do and makes a decision after the loan's closed and funded, whether we were right or wrong. And if they feel like we didn't do something right, they'll kick that loan back to us. It affects my license, it affects the underwriter's license. So we want to make sure that we get it right up front, because we can't keep our jobs if we're doing it wrong consistently. And so if the underwriter felt uncomfortable, they might make us average that base pay over the last 2 years with those 3 jobs instead of taking the new base pay. So if we don't calculate the income the way we feel an underwriter is going to calculate the income for that debt to income to be correct, then we'll have a problem later on down the road. And then credit score. What is the minimum credit score? Oftentimes people get really confused about credit scores. Well, I can't believe Guild's telling me I have a 621 credit score when Credit Karma's telling me I got a 668. Well, Credit Karma's every one of those credit scoring models have different measurements for different information on your credit report. They're going to be the same. A FICO is and there's several different versions of FICO, and I can't even tell you which year the industry-wide everybody uses. But we all use the same FICO version. So from lender to lender, your score should be right, with the exception of any information that's different on your credit report from the time I pulled the report till the time First United pulled the report 5 days later. Maybe a credit card reported something, a new balance or a paid down balance or a charge that wasn't on mine that might trigger a different credit score. But a true FICO is the only way you have a standardized measurement. All of those other discoverers told me my score is 778. Credit Karma is saying 668. Which one's right? Well, they're both right based on their credit model, but they're not going to be the same FICO. So when we're doing credit score, we're always going off of the middle credit score. So you'll have a TransUnion, Equifax, and Experian credit score, and we're going to go off of the middle of those two. Now we're also going to, if you have two borrowers on the loan, we're going to go off the lowest of the two middles of those borrowers on the loan, and that's what interest or cost are going to be charged to them based on that lowest of the two middle credit scores. Will determine what interest rate or price they're paying for the interest rate. Does anybody have any questions about those four common terms that aren't really that common? I mean, you think that you understand them, but there's a lot more history behind them. All right. Now the APR. The APR is a way for let me tell you the history of the APR and why we even have APR so that you can better understand what the APR is. So used to, whenever you're shopping a mortgage loan, you would be looking at the interest rate and that's all you had to shop with, right? Well, the problem is you don't know, like I could go online, we could go on to bankrate.com and you'll see interest rates anywhere from 5.5 to 7 1/8. What you're not seeing is the scenario or the scenario that they're using to post that score. I mean, that rate. They're also, in a lot of cases, not disclosing to you what fees are associated with that rate. And so it'll look like, oh, well, if I go with the People's Bank over here, I'm getting 5.5% interest rate, I'm going to go with them. What you're not seeing is what you're paying for that 5.5% interest rate. And that's why APRs came into play. So the APR is all of the fees associated with that loan rolled into a percentage. So technically, if someone was going to shop an interest rate, they would not be shopping the interest rate. They'd be shopping the APR because that's the true story. That tells you what the interest rate is and the fees associated with that particular loan rolled into an percentage. So it's always going to be higher than the interest rate. Nobody's giving a free mortgage. Commitment letter. A commitment letter is actually issued by an underwriter. So if you guys ever really wanted to, if you've got a seller that there's been 2 or 3 contracts that have fallen through recently, and seller is like, I just take my house off the market. I'm not doing this anymore. This is too emotional. You could say, listen, let's try again, but let's make sure that we get a commitment letter from either proof that there's money in the bank and they can pay cash, or a commitment letter. The commitment letter is actually the loan approval from an underwriter. It's not pre-approved. The underwriter has already signed off on the income calculations. The underwriter has already scrutinized the file and dotted all the I's, crossed all the T's. You're ready to go. That would be a commitment letter. That's also a good way to speed up closing. And Brandy, we may start doing some credit-only commitment letters with the new LPA adjustments. The reason you don't see more of those is because already, as we talked about in another class, for us to issue a real pre-approval, the thorough pre-approvals that we issue, we're spending 3 to 5 hours on a file, and we're spending $300 to $500 to do it right. to issue a real pre-approval letter, so you can go shopping. A commitment letter adds more time. Time is money. We have to continue to write, run more reports, and then, you know, you got the underwriter's time in the file. So it's very costly for a mortgage company to issue a commitment letter on everybody that is out house hunting. Plus, we would have to hire more staff. But we will do those when we're not 100% sure that the loan's going to go. So if we've got a real iffy customer, there's sometimes where we call it, we're just going to slam it against the wall, see if it sticks. Those Hail Marys. I don't think this hurt, but I don't be the one to say no because there's a chance. And we'll send it into underwriting, make it look as good as we can and get the decision. And then we know we're going. Closing costs. The class that we're going to do right after this is going to address those closing costs, the non-recurring and the recurring closing costs, so that you guys can better understand those. And then seller concessions is anything of value, including the fridge that's getting left. Anything of value is considered a concession. And every loan program has its limit of how much concession you can give for a buyer to purchase property. All right, does anybody have any questions over those 4 terms? All right. VA mortgages. So this, oh, we got a typo there. Brady, will you team chat BJ that on this slide, there's a typo? Eligibility is spelled wrong. On VA loans, the only person, I had this question. I'm going to ask y'all this question. You can tell me if you could do this. Have a customer whose dad is a veteran and his dad has never bought a home using his VA. Can the son have that on the loan and go VA? Danny, what do you think?
Well, it's kind of a loaded question, but I'm going to go with yes, because the VA benefit was not used.
That would be the assumption, but that is incorrect.
Dang it.
I know. No gold star for you on that one. Good logic though, because, you know, I mean, in theory, there's some dependent benefits, but that's not one of them. So on a VA loan, the only people that can be on the loan is the vet and their spouse. If you've got a 3-year-old veteran that wants to buy a home and he's out now, so he's no longer active duty, he's got a job and he wants to relocate to this area to come back home with his family, you know, bring his family to his hometown. If he does not have a job, mom and dad cannot co-sign for him either and use a VA loan. He has to qualify on his own. Now, you may have a veteran who doesn't work, but the spouse does, and we have the spouse on the loan. You're okay. But that's a question asked often, so I wanted to be sure to address it.
Hey,
now,
Michelle. Okay, Leah, same scenario. If the dad has a VA loan and he wants to sell the home to his son so that he can move to Florida and retire, can the son assume the VA loan?
You can go through a VA assumption, yes. Son has to qualify.
Thank you.
But
But
yeah,
here's the
good
deal with
scenario.
that. Can I throw in a kink? If he
Yeah,
does,
throw in the kink.
then dad loses his eligibility to get another VA. Or I say lose it, he can get another one, but he may have to put more down.
More down.
Yeah.
It won't release him. They'll release him from the liability, but they will not reissue certificate of eligibility for that balance if the son is a non-veteran, assuming a veteran's loan. he should have enough room to do another loan in Florida as long as it's not $1 million house. And he will need some money out of pocket. Active duty reservists and National Guard. So if you have someone that's just, they may be National Guard. I've got one that I'm working right now. She's National Guard, works National Guard 2 weeks out of the year. She qualifies for a VA loan. So most veterans know if they qualify. And we can run everything through the VA system to find out how much eligibility they have, so they know how much house that they can buy with the 0 down with a DD 214. Or if they're active duty, we can run it through the system too. It's pretty quick and easy. The VA guidelines, actually our credit score requirement is down now to a 520. See that many people, because just because they have the credit score and everything else fits does not mean that it's going to run through the automated underwriting system, but it could possibly work down to a 520. Now, if someone's got a 520 credit score and we're going VA, then we're going to be looking at that file very closely, because we got to make sure that they're still going to make their payments. So if they have a history of not making payments recently, it's likely not going to go through. But if they've got low credit scores because maybe they had a heart attack and they've got these big medical bills and it scores, but before that they had great credit, afterwards they have great credit, they just haven't score recovered, then it might work just fine. So when you're talking to buyers and they go, well, I've got terrible credit, I'm not going to qualify. If they're a veteran, they very well might qualify. So until the fat lady sings, I would not let someone go, oh, I can't. Let us look at it. I sing very well though. Now you can't, VA and FHA both are for owner occupied only. You cannot buy a house, go in VA, use for rental. I had that question the other day too. All right. Now, I think the funding fees have changed since this slide too, hadn't they? No, that's FHA up front and my. There is, you do not have to have a for a VA loan, which is one reason a lot of people like to use VA financing. There's also some other reasons. We talked in a previous class about disputed items on people's credit report. Whenever someone goes in and disputes it, bump their score, most loan programs are not okay with that, those accounts being in dispute. VA is the only loan program that doesn't care if the accounts are in dispute. Some other reason that a VA is a better way to go than a conventional loan, one of which, if they have a lot of collections. If you have a lot of collections, say you have $5,000 worth of collections on an FHA loan, we got to take $5,000 times 5% and count a payment of $250 against debt to income. But the VA do not. And sometimes, well, I'll get that question. It's like, well, they're putting 20% down. Why are they going VA? Well, number one, sometimes veterans use their eligibility. They earned it. Number two, sometimes the veteran needs to go VA because of some of the flexibility that VA offers. For instance, another really cool flexibility, got a veteran who's isn't on the loan because maybe they got a 80 credit score. Their spouse has some debts that we're having to count against the veteran because it's a community property state, but the spouse works. Sometimes we can take that income and offset the non-purchasing spouse's debt, so we don't have a debt to income issue. It's just some flexibility that VA offers that none of the other loan programs offer. Now, there is a funding associated with a VA loan. So no, they're not going to pay that payment, but they are going to pay a funding fee. And the first time they've ever used for their financing, the funding fee is only 2.3%. But using it for the second, third, fourth, or fifth time, they're going to be paying 3.6%. So that's a lot of money on a $300,000 house. It's over 10 grand. It's going to get rolled into the loan amount, but there is a fee associated with using a VA loan. Most veterans know that.
Sorry. But those fees have changed. They've gone down just a little bit. So I'll get that to BJ.
That's what I was
and get that
thinking.
updated as well.
Perfect. More down payment they have, then there's a reduction in the funding fee. So someone that is putting 20% down isn't going to pay as much in funding fee as someone that was doing 0 down. Because this is basically a recovery fund. That's all that is. Your upfront mortgage insurance and your monthly mortgage insurance on FHA and the funding fee on VA is just a recovery fund for foreclosures. And so in order to use their program, you're going to pay into their fund, their recovery fund. So escrows are required on VA loans. Now, the one thing that is a little bit different on VA is sometimes you have a disabled, service-connected disabled vet. And whenever that happens in Texas, and it's not this way in every state, the states treat the service-connected disabled vet differently. But in Texas, if they're 100% disabled, not pay property taxes. Now, some mortgage companies are going to go ahead and escrow for the property, and then get it waived through the appraisal district, they'll remove the escrows. We will have the veteran go to the appraisal district, get the documentation, get notification that they're going to have their property tax waived. We will waive the escrow setup of the property taxes. We're still qualified on the property taxes because if for some reason it doesn't go through, we want to know that they can afford this. An appraisal is required on every VA loan, so you're not going to get desktop approval or appraisal options, a hybrid that we talked about, or just the appraisal waiver. You won't see those on VAs. You're going to have a full appraisal. The appraisal was ordered by or through the VA portal, and there are appraisers that do VA loans, usually only VA loans. You heard from Chris Green the other day whenever we asked that it's hard to get on that list. So those VA appraisers are really busy, and typically that's all they do. But we do have to order through the portal. And there are only fixed or available for your VA loans. There's no balloons. The maximum loan amount, I think that's changed too, Brandy. The slides can hold fast. The maximum loan amount is going to be whatever the conforming conventional max is. That does not mean that's the highest amount that they could borrow. You could do a jumbo VA loan all day long, and it's the easiest jumbo loan we ever do is a VA jumbo. So if someone is going jumbo, which would be over the conforming limits for the loan limit, we always ask, are you a veteran? Because that is the easiest way to go. So don't be scared of a contract. If you've got a seller and it's a $900,000 and you see a VA loan on $900,000 at 0 down or 5% down or 10% down, don't be alarmed, and just really think your lucky stars that it's going VA. We do the Texas Veteran Land Board loans are available to Texas veterans. They have to be living in Texas to do loan. And what that does is basically they pay a fee to subsidize the rate. There are fees associated with it. The seller has to cover the fees. The buyer can't cover the fees. We don't see that used very often, but sometimes a veteran will ask. So you need to know that that is possible, that we can do a Texas, we can do the Texas vet. It is possible that it would be a smart option, but it's possible that it doesn't make financial sense. But it's always good to explore. Now, the concessions on a VA loan is 4%. So whenever you are figuring, here's the thing, it's 4% plus the VA non-allowables. All right. So if you had a $250,000 loan, the seller could pay 4% of the sales price plus the VA non-allowables, and there's a list of fees that are the VA non-allowables, which ends up being basically your title fees, your lender fees, some of those third-party fees the seller can cover as well. So most of the time gets pretty close to 6% as the max concession. Whenever you have those VA transactions and you're not quite sure if the contract is structured right with the concessions, even if Brandy and I are not on the transaction, you know, we're not under you're working with, send text, give us a scenario and we'll make the numbers look right. Because
Hey,
VA
Michelle.
contracts can get a little tricky. And we just want to make sure you guys are doing it right.
Hey, Michelle.
Mhm.
And on VA loans, can you do the interest rate buy downs?
Buy down? Is that what you said you cut out?
Yes.
Yeah, you
Yes,
can.
interest rate buy downs.
Yeah, you can do a 1-1 buy down, a 2-1 buy down, or a 1 buy down. Yeah, good question. Man, Danny, you're learning.
After 3 years, I should.
All right, on a FHA, again, we can go down to a 520 now. I don't want to like put that in, you know, on the billboard because those are really hard to do. It's really hard to get a 520 credit score approved. Just because typically a 520 credit score is pretty, I mean, it's years of missed payments most of the time or charge-offs and collection, but it's not impossible. Again, I would encourage everybody to try because listen, the worst thing that can happen is we say, no, not right now. We didn't say no, not forever. No, not right now, but do this, this, and this. And we could maybe say yes in the future, but they'll never know if they don't have. And we're not going to treat them like second class. I mean, because I mean, I've been there before. We've all came from somewhere. We've all faced hard times. And so we would rather guide them and help them get there, give them some hope so they can believe in their dreams. And we can't if they don't come to us. So please encourage. Debt to income ratios are pretty flexible in FHA. We even see them sometimes even on VA, 57 to 58%. Now think about that. By the time someone pays their house payment and their federal income tax, there's not much left. So what scenario would that really work with? Someone with really good credit and typically a spouse that also works and we just don't have them on because they don't qualify or we, you know, need them or whatever. We're not really putting people in houses that they can't afford. The maximum loan limit is going to be different by county. That part is important because you guys are traveling all over the place to find the house. And if you cross a county line, you better know what the income limit is. I mean, the maximum loan limit is for that county using FHA financing. I've seen it before where people went from Denton and they thought that they were okay up to that limit here in Grayson County. And there's a difference in the amount that you can borrow on FHA in between Denton, Collin, and Grayson. So Grayson, Cook, and Fannin typically have the same limit, and it's lower than your Denton and Collin. I need to look Bryan County. I think Bryan County is pretty much the same as Grayson and Fannin, right, Brandy?
I can look it up. I do know that Collin and Denton is, well, Grayson, Fannin, and Cook is 426.80, and then Collin and
426.80.
Denton is 450.800. Weird amounts, but
Oh, they're not much difference now. Yeah, we're moving up. We closed the gap. Y'all selling machines over here. Disputed account collections do impact the debt to income on an FHA loan. I'm not going to get into the weeds for that. Just know that that does matter. So there are some extra things that we've got to do when we calculate that. The general lines, the one thing really important to know is gift funds are acceptable. They're now pretty much on every transaction except for if someone is buying investment property. If someone is buying investment property, the assumption is they have their own money, or they should. So if they don't have their own money in their own bank account, buy an investment property, they shouldn't have the investment property. So just about all of the programs allow a gift. Now the documentation required is very different FHA and VA than it is on conventional. As we talked about in another class, the letter has to be in the file for a VA or an FHA loan and the bank statement of the donor. So if you know mom and dad looking at the house with the kids, or the kid looking at the house, mom and dad, and there's going to be some help from a family member, tell them up front, they're gonna need to provide a statement. Because the last thing you wanna find out is a week before close, you have a family member refusing to give a bank statement. Now we no longer have gifts and the buyer no longer has funds for closing. So address that up front. Escrows are required on all FHA loans. You can use the Texas Veterans Land Board on this on FHU. It's just tricky and kind of costly, so it hasn't really, I've not seen a scenario where it really makes financial sense. But some people will ask a question and you need to know, yes, I think that's possible, but you need to talk. All lenders will do Texas Land Bet, the land board, so you need to ask, but they need to ask those questions too. Again, just yeah, you cannot use an FHA loan on investment property. You can use FHA loan for unit as long as the borrower is going to occupy one of those units. We do not have them in this area, though I think that that would be a fabulous product to have on the ground.
Right, and retirees.
Yes, retirees, it'd be perfect. Somebody could help watch the house.
Yeah, I can't tell you how many times I've been asked for bucks where they can live it. So
I talked to you, I was at the office the other day during running around barefoot. I was looking very professional. And this developer stopped in. He's had land in this area for a while, and he was talking about now being the time to either sell them or develop them. And because he bought these chunks of land as speculative purchases. And he drives by the office all the time, and he's like, I'm going to stop in there and ask him some questions. So I, with my professional self, was answering all of his questions. So we were talking about the need being, I think we need multi-housing. The problem is the cities don't like housing, and they won't even allow it in Denison anymore. I don't know what Sherman's stance is. I don't know why. I didn't get in the middle of that because after Beverly remembers my stint, fighting the city on another situation 20 years ago, I vowed not to get in the middle of any of that anymore because it's very distracting. I get very emotionally charged up and then I don't make a living. So I don't know the reason behind the duplexes being allowed in Denison. I don't know what Sherman's stance is, but we do need more multi-housing for sure. And that would work with FHA. Yeah.
So Denison's like not gonna do anymore.
They're not building any more duplexes. They're not allowing a permit for a duplex or a multi-house, not a 1 to 4 unit.
Is it indefinite?
You call up there and ask them, talk to code.
Not very long ago, there was some stuff going on out there in the city.
Yeah, they stopped that about 6 months ago, I believe. There is a monthly FHA charge for mortgage insurance. It gets paid into the recovery fund. There's also an upfront. That just recently went down from 0.80 to 0.55. It was a pretty big decrease, which made FHA more affordable. So if you guys had people that were pre-approved 3 months ago, it is very possible the amount in which they're shopping in could be increased based on the changes that have been made. So go through your database and I encourage you guys to take the information that you're getting in these classes and think, who have I talked to in the 3 to 6 months where this information might be beneficial? Pick up the dang phone and have a conversation and get them excited about looking again. Send them a text, send them an email. You could record a video right outside with the Greater Texoma or right here in front of the slide and go, oh my gosh, I was just in a class today and I learned some information that might be helpful to you. Are you interested in getting out there and searching for a home again? I mean, like, use this information to your advantage to build your business. Because those changes will affect what house price range they qualify for. So do the interest rates. And if they're not staying on top of that, I mean, we go through the pipeline continuously and look and see, okay, who is affected by this change? Who is affected by this change? Who is affected? And send information out to them. But if you guys are doing that same thing, then we're both with different, just information. We're not pestering them, we're providing them information. FHA and VA just have, people are asking all the time. I got a picture of a house the other day. It was a great looking home, freshly redone. But behind the house looked like more of a log cabin or it was just an old structure. And the wood was weathered. There was no paint on the wood. So the question was, will this go FHA? Well, FHA, with the class that we had with Chris, safe, FHA is for safe and sound. I don't think they have the word sanitary in there, but maybe they do have sanitary. So my question was, if someone was playing football out there and the ball hit the building, would the building collapse? Because if it would, then that is not safe. But the other thing FHA is going to be looking for is if there's no paint, then you got to worry about rotten wood, right? Because now the weather is exposed to the weather. There's nothing protecting it. So if you have rotten wood, the structural integrity of the building would be compromised. So it likely would not be considered safe. You also have wood destroying insects that would go ahead and eat through the wood, again, causing a health and safety issue. So the question is always just look around the house. Look for rotten wood and peeling paint, because if there is any of significance, it's going to need to be scraped and repainted with the same color paint that's on, around it, and 2 coats, because 1 coat's not enough to protect.
Always people say, why won't the sellers go with FHA on this?
Because the seller doesn't want to do the work.
And that's what I tell them.
Yeah. The seller doesn't want to do the work.
It's so minimal, but really.
Well, but there's a solution to that. So if you got a seller that I had a call the other day, and there was like 3 or 4 different things that done. There were called out the inspection, and they really were things that were probably going to be called appraisal. So, but the seller doesn't have any money to pay someone, and the seller's not in town. So I thought, well, this is an easy solution. Of course, the seller is to sell the house. If they don't do these things, they limit their buyer, right? So if they're going to limit the buyer and it happens to be in a price range that is an FHA range, let's figure a solution. So instead, let's get a bid for what it would take to get that done. Let's get the loan fully processed, get the appraisal, make sure everything's fine, make sure that we do address the call out on the appraisal. And then we can even get the documents to the title company. Someone out at work and you put them on the CD 48 hours after the work. Who's going to say no to that? Like, seriously, there's always a solution.
I'm working a deal right now with that.
I mean, we've done those over and over and over and over through the years.
Several of those and actually went out myself.
I did the work. Yeah,
I
I've-
did some painting.
I've-
Make a house.
I've done that too, but now I have too many adult children with houses that always need work.
I would do that now.
Yeah.
This is BJ.
Beat yourself.
Oh,
So broken windows, an issue with FHA too, and you always have to have a window you can raise in the bedroom in the event that there's a fire or they need a quick escape. Those are some of the things to be looking for. The other question that we get asked a lot too is an operable HVAC. In Texas, you do have to have there's a gray area on whether or not you have to have heat source. So I'll just tell you the safest way to make sure that you don't have any issues. Make sure that a vented, thermostatically controlled heat source. You also need technically we don't have to have air conditioning, but that is a safety issue because it does get pretty hot here. If there's an HVAC system, that system needs to be operating. So if you have an HVAC system that's broke and someone's got window units and furnaces, they need that HVAC system has to be fixed. Because you can't be leaving the ductwork and all of that just to be a tunnel for rodents, somebody else.
But it can just have window unit.
But it can, if there is not an HVAC system, you can have a window unit and thermostatically vented heat.
Has to be recently
Mhm.
in the modern day.
Mm-hmm. Yep. All right, seller concessions on an FHA loan is capped at 6%. We're not really seeing any of those. We're not, I mean, 6%, that's $12,000. We don't see that many contracts written with that much concession right now, but it is possible. So just an overview, the comparison, because we get that question asked a lot too, what is the difference in conventional and FHA loan? Well, here you go. Most of the time, someone going FHA is going because of the difference in the mortgage insurance premium. Because someone with a 620 credit score on a conventional loan, their monthly, so FHA's monthly mortgage insurance premium is 0.5%. On a conventional loan, it's probably going to be 1.86%. That's a big difference in their monthly payment. So not only would it cost them more per month, but it must also put their debt to income at a level that we can't make it work. But if someone's buying a vacation home or investment home, they have to go conventional because FHA and VA is not an option. So there's sometimes where, showing a house and you go, this house will not go FHA. It has to go conventional. And so then we'll switch everything around and see if there's any way we can make it work conventional. And it may work just fine, just may be more expensive. Now on a conventional loan, 620 credit score is going to be your minimum. Most places have a lot higher credit score requirement. The difference for us is we retain our loans. We keep our loans. So we have a history of performance and we know what our tolerance is. If you're selling your loans, then you have to go with the terms of the most conservative person that you might sell the loan to because you don't know who you're going to sell the loan to. You're having to underwrite to higher standards. So we have some flexibility that that a lot of places don't have. Now the maximum loan amount has changed too, because as prices have gone up, the maximum loan amount is on a conventional loan. We are starting to see houses on the market that exceed these conventional maximums. So you need to know that it's like $800 and something thousand. Brandy's looking it up, I can tell. She'll tell us in a minute. The cash reserves are typically required on a conventional loan. Conventional loans, we normally get them approved with them every penny they own to get in the house. They're gonna need a little bit of money. And if they're buying property or already own rental property, they're gonna need more money than they would if they didn't have that rental property. Because we're gonna be looking at making sure they have enough money in their bank to make a couple more units in the event that they had to do that. Minimum down payment is 3%. There's two different loan programs available for the 3% down. One of them has an income limit. One of them has a first-time home buyer requirement, where one of the two borrowers is a first-time home buyer. But 3% is an option on conventional loan, which is a fabulous, fabulous way to get someone in with little money. The mortgage insurance is going to be determined by the credit score, debt to income, and loan amount. So it varies. Whereas on FHA and VA, it's a flat amount. There is no variance. A conventional appraisal, that part of the slide needs to be changed too. An appraisal is not always required on a conventional loan. It really just depends on how much data is available on the national base of values of homes like that one in the neighborhood. Seller concessions. I'm going to move you guys over on Zoom because I want to be able to see this. All right. The down payment's going to determine how much the seller can pay in concessions. Most people do not realize this. But for someone to get 6% concessions, they got to be putting, the customer's got to be putting down at least 10%. But if someone was putting 20% down, There's not a limit on the amount in which the seller could pay. But it can't exceed the actual cost of the closing cost and the prepayments. They can't contribute to their down payment, basically. And again, just like any loan program, concessions is closing costs, any furniture, any enticement to purchase, even to the point where we get contracts sometimes where they're being left behind. Our underwriters laugh at some of our contracts around here. Every loan program requires that we prove that they have the ability to repay the mortgage. And the way we're going to determine that is, do they have a job? Do they stay on their job, or do they quit and change jobs every 6 months? Do they have steady and stable income? The biggest thing that we're fighting right now that's a challenge for us is what's considered variable income. Variable income is basically anything that's not the exact same income 2 years in a row will be considered variable income. And that is kicking our butts right now on how the underwriters are going to want us to calculate that income. Deals fall apart with other lenders, I guarantee it, it's over the income calculations. If we don't do a great job up front on the income calculations, that loan's going to get messy at the end every single time, which is why it takes us longer to do pre-approvals. But nobody in our office will ever release a pre-approval letter where we have not received all of the income, all of the employment data, and all of the different ways that the income can be calculated, determine which of those ways we're going to use to pre-approve someone. It's time to do it right. But if we didn't do it that way, our deals would fall apart and get to the end. And life's just way too short for that. Plus our reputation means too much to us. So those are things that we're going to, now if someone's self-employed, we're going to need all of their tax returns, personal and business, with all of their schedules and K-1s. And until we have that, we can't calculate anything for them. What we do when someone completes a loan application, then we go through the loan application and we determine what paper they need. And then we're going to tell them, hey, listen, I'm going to send you a secured link. And each, there will be a folder that describes exactly what we need from you. We need you to upload that information to us securely. So they either drop it off in person or they upload it securely, because I don't want anything emailed. Because have any of you guys been had wire fraud happen in your office? It happens. There are people out there trying to steal information, and any kind of pay stubs being emailed to me or tax returns being emailed to me, all of a sudden now their email address is flagged, and it just makes them more likely to be hit by fraud. So we're not going to ask for any to email anything to us, confidential information. They'll always get a folder. Every lender everywhere need the same paperwork. So if they're talking to another lender and they haven't provided that paperwork, they're not pre-approved. I don't care what the letter says. All right. Some of the things that are figured in all of the debt to income that we have to take into consideration. Obviously, payments matter on credit cards and car loans and side-by-sides and all of that. But business loans, rent loss. If you've got someone, I had someone the other day on their tax returns, they were showing a big loss on one of their rental properties. It was vacant. Towards the middle of the year, the house was torn up, wanted to remodel, freshen it up, since it was torn up anyway. And so there was a big rent loss. Well, typically you would count that rent loss unless I can prove that period of time and it was taken out of service. And I did that out of there with proof of receipts that they did all of this work for the house and then re-rented it with a copy of the lease agreement. But all of that rent loss has to be taken into consideration if it's true loss and not just a one-time expense. Child support and alimony. Any liabilities that the customer has, we have to consider whether it is or is not on their credit report. And that's with all loan programs. They're going to require that. So there is a qualified mortgage based on the CFPB's definition is a qualified mortgage means that We have the documentation that we have verified that shows that the customer has the ability to repay. If we don't do a QM loan, and you'll hear that word QM, if we're not doing a QM loan, or if someone's not doing a QM loan, that they do not have the protection from the CFPB. Those non-QM loans would be like that bank statement loan and the DSCR loans and the stated income loans that we are starting to see some of. Or USDA is non-conforming, but it's still QM. For those of you guys that are curious, USDA guidelines are pretty much the same as FHA. It is a little bit harder to qualify than FHA, and it's 0 down. We are trying to use them as much as we can, but with income restrictions and their stringent writing, we don't get use them as much, but those are available as well. Those are really, even a reverse mortgage is a QM. I can't think of any other QMs. Anyway, y'all, there are so many different variations within Fannie Mae, Freddie Mac, FHA, and VA. There's 2 loans I wanted to make sure that you guys are aware of. We talked about one of them last week, the 321, where the customers put 3% down. They're getting $2,000 credit from us at closing, and we're giving them a gift card to Home Depot up to $2,000 at closing. It's a pretty cool program. It's a Fannie Mae loan. FHA, we have a way now. We do a lot of grants. We do a lot of bond loans. They have their own quirks. They all have their own income limits. Some of them are qualifying income. Some of them are household income. We talked about that last week and the difference between them. Sometimes people don't qualify for those programs because they make too much money, but they still don't have enough money to buy a house. We can do an FHA loan where we loan them the money for the down payment. That sounds funny, but it's possible. We loan them the money for the down payment. The bummer part is the interest rate is going to be 2% higher than their note rate. So if their note rate, say they have marginal credit and their note rate is 6.875 on that second lien, it's going to be 8.875. But if they don't have gift funds and they're paying rent, what are they paying on rent? 100% interest, someone else's payment. So it's still a way for them to get in the house. I tell people all the time, the sooner you own a home, the sooner you're building wealth in real estate. So you need to get in a home as quickly as you can, because you're missing an opportunity every single month that you're paying someone else's mortgage. All of the things, we have this as a flyer. I highly recommend you have people sign something that I'm not going to do anything stupid to jeopardize my approval, my pre-approval while I'm house hunting, and get them. I mean, we send that to them as a screenshot whenever we get their loan in processing. It does not mean that they'll follow instructions. I had someone the other day even say, well, I thought everything was fine and I could change my job and it wouldn't matter. Well, it does matter. So we do have this flyer in several different variations if you want a copy of it. Because at the very end, we're going to pull credit again 5 days before closing. And we're going to see if they've opened any new lines of credit. We are going to also verify their bank statements again at the end. And we're also going to verify their employment through. So all of those things matter. Marisa, Nicole, Brandy, and I are licensed loan officers. Dylan is our transaction coordinator. He's not licensed, though he's very helpful. So if you guys have anybody that has any questions, I don't care if they're ready to buy a house today or not. Let us have a conversation with them. Yeah.
So you can if I send somebody to they have no money saved or they don't have good credit, you can at least get them on track to not now, but
yeah. I mean, it just helps sometimes, but tell us that. Tell us, say, hey, friends of mine to you, we were talking out at the lake this last weekend, and they don't think that buying a home is ever going to be possible, but I told them with you that you would put a plan together for them. Give me that heads up ahead of time, because that will change the conversation. And then send an email to them and to us in the same email, and introduce us to them and them to us, and say, hey, these are the folks that I was telling you about. They're friends of mine. They don't think they'll ever be able to buy a home, but I told them that it is possible for anybody to buy a home if they have enough time and patience. Will you help them? And then they have our contact information, we have theirs, and we'll just reach out to them and we'll see what we can do and put a plan together. And then once we put a plan together, we live by our CRM. And after we have a plan put together, then we'll set reminders in our computer to keep reaching out and encouraging them. Because sometimes they lose, they get distracted, they get frustrated, they forget what they're working on. So we'll continue to reach out to them. Yes. And then if you wanted to have my a QR code in my calendar, so if anybody wants to book my calendar, just take a picture of that, it'll go straight to my calendar and you can book from there. And if you are working with Brandy, but still want us to brainstorm together, you still want to just meet with me, that's fine. No problem with that at all. And we can give Brandy the notes, so Brandy can join us, or you can book with Brandy. We just want to be a partner for you guys. This job is hard. We all got to work together. And then if you, there's only one more class for the series. We'll do it next week. It's on marketing. I will take a break for the summer, although I set up the cutest little room at our office. It's like a little tea room on our back porch. And I'm going to do spill the tea, and we're probably just going to have more casual, hey, what's your biggest challenge right now, and kind of work through challenges. We'll do that this summer for fun. Maybe we'll even have some cocktail teas with mocktail available. So just pay attention to the education page. And then also, if you're not already a part of the Facebook group, please join, because that's where we really collaborate and work together. And I also put out all of the newest information out on that. So make sure that you're part of it as well. And then I have, if you need to pick me up at the beginning of every day I post a new affirmation. And then there's some other really good stuff that gets posted in this Facebook group called Elevate Your Thoughts. I'm a big believer, if you want to change life, you just got to change your thoughts. If you just change your mindset, life will change. So I have that group designed just for that. I don't know if did that work with that bar? No, Carmen, I didn't think so. So that's what that group is all about. So I just wanted to be sure to go through those. Now, Bill had asked about the LLPAs and all of the hoopla you guys are hearing in the news. Do y'all want to go over that?
Hey, Michelle,
Yeah.
real quick on that. I think I sent you the longer version, and I was trying to copy over just a picture, but it's not allowing me to do it on the thing. So do you want me to?
Why don't you just share screen? Are
Okay.
you through, Carmen?
Hang on.
Yeah, share screen. I want to go over that with everybody. While you're doing that, explain the way interest rates work. All right, so here's the scenario. Y'all write this down because I'll forget the scenario. Let's say someone has a 720 credit score, because we're going to look this up on the chart.
I don't think it's letting me share screen.
That's weird. Is this the one you had? Is the chart not in this?
Yeah.
Nicole put,
It's a little bit more complicated, but.
well, you know that Nicole had that chart that she put in our Sherman team chat the other day, but I couldn't find it earlier just because I ran out of time trying to scroll for it. This will still give them an idea how it all works, though. All right, so, oops, dang it. All right. So let's just say we have a 720 credit score. Now, you guys remember from previous class that is not average for our area. The average credit score in our area, I think, was like 680, wasn't it? Yeah. It's not normal that we see a 720 credit score in our area. But you see, whenever you are, when we're figuring what the cost of a rate is going to be, you have to take into consideration their credit. Now, the other thing that would be new for us too, we have to take into consideration their debt to income. So their credit score, the amount of money they're putting down, the purpose of the purchase. So whether it's going to be a vacation home or investment property or their primary residence. There's some other adjustments, whether it's a one, 2 unit, 3 to 4 unit, all of that matters. The things that you're also not seeing that matters is how many days we're locking the loan. So if you guys are writing a 45-day contract, there's going to be a cost associated with the additional days when we go to lock the loan. Property type is not on this chart, but that also matters. So basically you have like base interest rate. So you look and go, you figure out, okay, if you got a 720 credit score and someone is 8% down, then you're going to have a 0.875% charge. Write that down. Okay. Now, they also, because we now have the changes that are being made based on your debt to income, let's just say in this case, they're buying a single family home, a primary residence, single family home, and they are, their debt to income is in the intermediate range versus a high range. And we're doing a FHA loan. I mean, we're doing a 30-year loan. All right. So we're doing a 30-year loan. Their debt to income is in the intermediate range. And primary residence, there's a 2-point hit for the debt to income. Okay. Now, we'll stop right there for the adjustments rather than keep scrolling on and because I just want to hit home how this works. I'm going to go to our pricing engine now, and I'm going to put that scenario in 720 conventional loan, 30-year fixed, and single family primary residence.
Michelle, could you screenshot, please?
Oh yeah, that would be important because you're going to want. Danny, you've been saying that for 3 years. You're my screen share checker. All right. So I'm going to put 720. And we're going to say that the debt to income is 48%. It's above the guidelines. So they're going to pay a premium for that. It is not a manufactured home. Hang on. It's not non-traditional credit. It's not a manufactured home. Single family owner occupied in Texas. I also choose the county because that matters. Location matters. Okay. Conventional loan. Jesus, is hard from here. Fixed rate. 30-year. And because they're 8% down, they do have to do escrow. So I'm marking the impound box. We're not doing any buy downs or funky anything else, just plain Jane. And we'll do this as a $325,000 house. Oops. And 92% debt to income. This is a purchase. Let me show you what happens then. It's going to show us all the loan programs that would be available that has that fits that criteria. All right. So I've got to basically, I need to pretty much know my loan guidelines on everything that's listed here, so I could determine which one really is an option for this particular customer. But we're just going to keep it simple, super simple, and go to a plain Jane loan. All right. So the base rate, the system's going to try to find something with as little money out of pocket for discount points as possible. Let's see if I can get it on down there so they don't have to pay discount points. Nope, that's on the opposite direction. Nope, that's still going to be a better rate. Look how funky that is. Okay, there's one discount point at 7.375 on this scenario. If I try to offer someone, they don't want to pay discount points. The most I could go up to is 7.875, and they'd still be paying 0.5%. That's something that's changed in the last year or so. You can't find a par rate. You cannot find a rate that does not have any discount points associated with it. It's not possible. And the reason is because every investor knows that we are going to hit 5 boom, and they want some money up front. So because it takes 7 years for an investor to make money on a loan, they paid for that loan. But they have to service it for 7 years for it to be profitable. And so they know we're going to hit a refi boom, and there's a good chance that a large percentage of the pipeline is going to refinance. So you cannot find one that does not have any fees up front. There will be discount points. But interesting enough, look at a 7.75% come to 7.5. So this really ties to the whole closing costs and the prepaids and recurring fees. So a 7.75% rate is still costing them three quarters, right? Well, if I go over here to 7.5, I could offer them a lower rate for the same amount of money out of pocket. Because these are also going to be priced based on what the investor knows that there's a greater chance that someone's going to refinance a 7.75% rate than a 7.5. So they're hedging the market based on what they think is going to happen with their turn and, the turning of their the turning line later. Remember, it's just investors that are hedging the bond market to determine how they want to invest their money and what their thoughts are on their return on their investment. Well, the higher risk of the customer, the lower the return on their investment, right? And so your consumers are paying that. But this also explains to you why some lenders will go in here and do a pre-approval letter and say that the interest rate's going to be 6.99%, and someone else is going to go write a pre-approval letter and put it at 6.625. Because you guys just saw all of the things that are factored into a credit score, right? I mean, to an interest rate. This changes daily. Every bit of the information that's on here changes daily, except for the cost of the interest rate. You got a base rate, and you have the points charged for that base rate. And then you have to add to it all of your risk factors. So the LLPA changes that we are experiencing, that everybody's up in arms about, takes those adjustments. These adjustments right here are adjusting based on the risk. So someone with a lower credit score, if I ran the same scenario and we put a 620 credit in here, let's just pick a rate just for comparison. Let's just say we would offer them a 6 point, they're on contract and they're able to lock the loan today, right now. Otherwise, all anybody's doing is just throwing numbers out there. Nobody can shop an interest rate unless they are shopping APRs on the day that they're ready to lock in the loan. Otherwise, they're wasting their time shopping interest rates. All they're doing is gathering a bunch of numbers that mean nothing because you can't lock in the loan. So it just drives me crazy when we lose a loan because someone's shopping. They're not shopping because they can't shop, because they can't lock in a rate. So, it drives me nuts, especially after we spend the time and money to get someone pre-approved. And then all of a sudden, Cousin Eddie over in another state's going to give them a loan because, they forgot Cousin Eddie's even in the business. And he does 3 loans a year and he doesn't know what he's doing, but that's okay. He's going to give his cousin a better deal after we've done the work, whatever. So a 6 point, say in this scenario, 720 credit score, 8% down, regular home, single family, owner occupied in Texas, closing in the next 30 days. The discount points would be 1.75. That is a non-recurring fee. It's a one-time charge. It is prepaid interest for a tax write-off. Okay. Now let's just change the scenario to a 620 credit score. So you can see, where's my search button? So you can see how that changes the whole scenario. So let's just say that we talk to husband, husband's got great credit score and we give them that quote for an interest rate. But they want to bump up to a 375 price range. And the only way to do that is to put the wife back on the loan, but the wife's got a 620 credit score. So now he's going to pay more because he has to have her on the loan to get the house they really want. And they've got a 620 credit now that we have to price everything off of. So now let's go over here to search so you can see what happens. And I wish I had a side-by-side for you so you could see. Hang on, I lowered something too much. So I'm going to go back to that same loan program. Where is it? There we go. This is a Freddie Mac 30-year loan, same loan program. And now let's go down to the 6.99% interest rate. Okay. That same scenario, but because we had to add the wife so they could get the house they really wanted, the discount points are now 3.125 because of the risk associated with that credit score. Now, Bill, what we're talking about and what changes made reduced this cost, but there's still a cost associated that's higher than what the cost is on the 720 credit score. This is with the new loan level pricing adjustment. So where you see people saying, well, I'm subsidizing those with bad credit and now they're going to get to buy a house. Now I'm getting penalized. BS. Those with the lower credit scores are still paying a higher premium for the rate. They just lowered the premium they would have paid. So if I were to run this scenario 3 weeks ago, then that cost would have probably been like 5 points or 6 points. I can't even remember. I mean, that chart is so complicated the way they adjusted it, and I didn't memorize it. But it was, so basically these people wouldn't be able to buy because in Texas, I can't charge them that many points. So this opened the door for more people to be able to buy houses by lowering the cost associated with those lower scores. But it's not at the expense of good. Their cost changed too based on debt to income and other factors. And there is a little gap there that if you're putting between 15 and 20% down, the premium is more than what it would be if you put a little bit more than 20%. So if someone comes to me and they were going to put 20% down, I'd say, hey, put 21% down because I could save you more money doing that way than you just putting 20% down because of the cost associated with the 20% down. There's a workaround for every one of them that actually makes more sense. But what you hear the news talking about is not the benefits. Now, the other thing that is super cool too is if you have a customer that is marginal credit and their income is below a certain AMI, I'd have to pull that back up. There are no fees charged to them for their credit profile if they're below a certain income limit. So it's really open for some of our first-time home to be able to buy homes. If our move-up buyers that are more established in credit scores and they're more established in life itself had more buyers buying their homes, could we sell more homes? Yes. Does that benefit everybody? Yes. So whenever you hear all that, I don't, if you guys have a hard time and, saying that in your own words, call us, we'll help you. It has been a little bit hard for all of us to really put into words. So that's why I showed that to you instead of trying to explain it. Does that make sense, Bill? Does anybody else on the call have questions? Okay. Well, get out there and bust those freaking myths. I'm so tired of hearing it on the internet. Oh, people need to know that's not what happened. All right, we're going to pop over to closing costs and prepaids. This is a really fast one, which is why I took the time to go over the LLPAs because I knew that we would have time. What we're going to go over today oops, went too fast. A loan estimate versus a loan cost approximation. Loan estimate examples, and let you see what a cost approximation looks like. Rates, cost, and programs, which we just covered. If I were to go in there and I would have changed that to FHA or VA, you would see that there are different adjustments for each one of those loan programs based on credit profile, because all have their own risk tolerance. We're going to talk about seller concessions, the VA non-allowables, the minimum contributions, and all of that stuff that you guys need to know in order to answer people's questions. There is a difference in a CD and the LE. So I want you guys to be familiar with that too, and how to notice your cash to close. All right, so a loan estimate. I don't remember how many years ago it was only a couple of years ago that we went to the loan estimate. Now, the government wanted to provide something that was easier for people to understand and read. And that's what changed from the HUD ones to the loan estimates. We had a HUD one in a truth in lending disclosure, two different disclosures that you would see at closing. And they combined it all into a 3-page, well, really a 4-page loan estimate. There is a difference in a loan estimate and the loan cost approximation worksheet. Most of the time, what you're going to see from a lender whenever they're disclosing up front what the fees are going to be associated with the loan is a loan cost approximation. Because if we go in and we open a loan estimate, we fully have to process that loan to issue that loan estimate, put a property address in there. Well, if you're asking for a loan estimate based on a property, and that property is not the one that they make an offer on, we have to totally withdraw that entire loan out of the system and open a brand new file for you guys, for us to be able to play with figures on the next loan. It's a government thing. It's not it's industry-wide government thing. But honestly, a loan estimate is the only way for you to see what the fees are the lender is bound to charge. Once we put fees on a loan estimate, we're bound to those fees. And if we're wrong, we eat it, which is another reason you will see LACALs instead of LEs. The problem is a lender from Timbuktu can put together a LACAL with all kind of information on it that they're not familiar with in our area. And so you can't guarantee that the information that's being disclosed is accurate, because there's nothing legally that binds them to those fees. It's just a best guess. On an LE, we can't best guess anymore. We have to actually call around and get the fees, even to the point where if there's a septic system and it needs to be pumped, or it's going to need to be inspected, or there's a well, or there is some question about the structure, whether or not we're going to need a structural engineer's report is in question. And if we don't disclose it, but we knew about it up front, I have to pay for it. So you need to tell us everything that we need to know in order to accurately give an LE. Now, fortunately, that LE looks a lot like the CD. So people aren't so unfamiliar with the CD whenever it actually comes in. But what's so great about it is if you look down here in the middle section, payments, you'll see years 1 to 2 or 1 to 3, and then you'll see years whatever. That is disclosing to them when their mortgage insurance is going to fall off and how much their payment's going to go down because of that. It also includes the estimate for taxes and insurance, which is really important for you to know. I talked to a guy yesterday. He's looking at a $250,000 house, and he found the house on Zillow. And I said, fabulous. What agent you're working with? Because you're going to want an agent that's local, that's familiar with the area, not always your Zillow agents that are buying that impression that you just clicked on is local to this area. And he told me someone, that's a local realtor. So cool. All right, 250. What has you looking in that price range? Are you comfortable with the $2,500, between the $2,100 and $2,500 payment? Oh no, I need to be at $1,200 a month. All right, well, you're looking in the wrong price range, but let me just ask you, what is the payment showing on that Zillow posting? That's why he thought that it was okay for him to be in that $200,000 price range, because Zillow did not accurately figure taxes and insurance. In Texas, our taxes and insurance are really high. So it always shocks people. So if you can get your hands on on an LE and someone is saying that they're getting a better deal at another loan, at another mortgage company, get a copy of the loan estimate. Because that's where you'll see the discrepancy. And look down here for taxes and insurance. I guarantee that they think they're getting a better deal because the taxes and insurance are lower. When it's taxes and insurance aren't going to be that low, because that is one fee that the lender is not to. The other area to look, so not only are you going to see that discrepancy in the taxes and insurance on this first page, but whenever you go over to the escrow side of things, and this is pretty small, you'll see on the recurring means that they're going to pay this fee over and over through the life of the loan, so it's recurring. You'll see we're collecting for 12 months of insurance up front because the insurance agent, the insurance company is going to be paid at closing. So if there is a discrepancy in the insurance or taxes, it's also going to show up here, which is going to make their closing cash to close thousands of dollars less if it was not calculated correctly because of how we're collecting those. The other thing that we'll see sometimes is, remember, we've had that conversation before. You have a piece of property and it's got over 65 exemption on it, and your people are 23 years old. They're not going to get that over 65 exemption. You're going to have to collect the escrows so that there's enough money in the account to pay the whole bill without the exemptions, because the appraisal district's going to tax them based on the tax without that escrow. So I'm going to collect more money because I know that, because I'm paying attention to when we get a property, we're looking at the exemptions, we're looking at the taxes, and we're going to collect enough money that we know we're going to be okay. The other area that will be different, or you will see a lender different from lender to lender, is if they are setting up the escrows based on what the taxes will be or what they currently are. We're going to set them up on base what they will be, because I don't want someone calling me telling me they can't afford the house because of escrow shortages because I tried to make their numbers look good in the beginning. I'm not going to do that. And so, but you'll see there. So if you have someone that says, I'm getting a better deal somewhere else, tell them, would you please send me the loan estimate? Because I just went through a class and I know some areas that I need to look at and make sure that they're accurately estimating the costs. And
Michelle,
look in those two areas. Yeah.
on the previous page, you were talking about the over 65 exemption. In the state of Texas, is there a maximum income limit to qualify for the 65 and over exemption? In Oklahoma, I think it's like $32,000. If you make more than $32,000, you cannot claim the over 65 exemption.
We don't have income restrictions on the over 65. Thank goodness. Yeah. But that's a really good question. And that's another thing. I mean, we have to know our Texas. Yeah. Yeah. So those are the two areas that you need to pay close attention to. Everything that is in loan cost block A, the lender cannot change that. That is fees. They're bound to those fees. In blocks B and C, those services that people can shop for, it can only vary by 10%. An aggregate, you take the aggregate of those two blocks and it can't vary in 10%. But if you compare to taxes and insurance, it can vary however much, which is why lenders oftentimes will cheat the system and show low taxes and insurance just to get the deal, because it'll make their bottom line and their payment look better. So you guys just ask questions and get copies of this stuff and know what you're talking about. And if you're not sure, send us a screenshot and send us an address and we'll tell you what they should be. That last page where we were talking about the APR, it's going to be on the third page. And the APR is the only true rate, because it takes into consideration the interest rate, the loan amount, the terms of the loan, and the loan amount. I mean, well, the loan amount matters too. I skipped something, but anyway. All right, so that's the other area that you're gonna look at. Now, if you're looking at a loan, it's gonna look more like this. and it's gonna have the same information, they're just not bound to the fees. So if the lender did not issue a loan estimate, it's still okay. Ask for whatever it is that they did issue and look at taxes and insurance, because that's where the numbers are gonna be different. Does anybody have any questions about that? Oops, went too far. All right, now, just like we talked, people cannot really go shop the rate because the things that affect the rate is so many different factors. And unless a lender is looking at the entire profile, they're gonna be missing some of the information. They're just throwing numbers out there. So you have to have all of the details of someone has to do an application. We got to pull their credit report and we need to run their loan through AUS. And really, before we run a loan through AUS, we need their income and their employment information. And then we can give them an accurate interest rate based on today. By the time they go under contract, it could be different. And if anything that they do changes their debt to income between the time they started house shopping and the time you find them a house, it could be that the cost of that rate is even more because maybe they bought a car. Or maybe the cost of the rate's even less because they traded in a car and lowered their payments. That stuff is going to matter. So when you're talking to people, again, get on your phone, get on text, get on emails and go, listen, there's some really great changes that have just happened. But there's also some changes that kind of scare me just a little bit. And we've been house hunting for a long time. Please get a hold of your lender and have a conversation and make sure nothing has changed in your pre-approval. It's just another reason to be reaching out to people, which you should be doing every month anyway. We went over the grid, so you guys have an idea how that works. This is now needs to be updated based on the new grid. But these are just all of the things that could affect the interest rate. Even the lower loan amounts affect the interest rate. If their second lien is going to affect the interest rate or the cost of the rate anyway. It's a long list of things that affect the interest rate. Those are fees in the first block of that loan estimate. Minimum contributions, you guys, we talked about that. Usually you're going to see your minimum contributions on the CD. Second page, same thing on the estimate. On these buy downs, you're going to see the credit from the seller on a buy down on the concessions. And that is part of your concession calculations. So just remember the cap on your concessions. The non-allowable fees that you'll hear on VA loans are basically third-party fees that the veteran can't pay. VA says that the veteran can pay up to 1% of the loan towards their VA non-allowables as long as they're not paying an origination fee. So calculation can kind of get a little funky. So if you're not sure, just run it by us. Closing disclosure. The one thing that you need to know about the disclosure, and what I love about the closing disclosure, is it has to be disclosed to the customer no later than 3 days prior to closing. You guys cannot close a loan until after that closing disclosure has been received and signed by both borrowers. And they have till midnight of that day to do that. I know y'all have a cutoff on y'all stuff at 5 o'clock now. Ours, we still are at midnight on that day. What we do as a mortgage company, we as a Guild Mortgage, as soon as we have loan approval, we're issuing a loan, a CD. We don't have all of the final figures, but we have enough that we can issue that closing disclosure. So we've satisfied our 3 days. Not all lenders will send it that early, but why I'm telling you is because I want y'all to know if your customer says, well, I've already signed the closing disclosure, the initial closing disclosure's been signed, but we're going to every revision we issue has to be signed. So if through, say that we thought we were ready to close and then all of a sudden we find out that the will hadn't been probated. and now there's, you know, something that's changed, be the time that we issued the CD until the time that we get one reconciled with the title company, and there were 2 or 3 in between. You're gonna need to go into DocuSign and sign all of them. The closing disclosure itself looks real similar to the LE. There's just a little bit of difference. There's more details on the closing disclosure than there was on the LE. Some title companies will put all of the seller fees and everything on the closing disclosure. Some of them are using the, you know, their own form to disclose all the seller stuff. But anything that pertains to the loan, some credits for maybe the title policy of the survey that is paid for by the seller, or those repairs that we were talking about, you know, if they do repairs at the end and we get an invoice, that's going to be on the actual CD because it applies to our side of the transaction. It's got to be in the file. We also are going to disclose, you know, the APR and just more information about the loan itself. Any questions on that part of it? The other thing that's going to be a little bit different on CDs from lender to lender is the customer is going to pay interest on the day they close till the first of the following month. So if I go in there and I put a closing date of 3/31, then there's going to be just 1 day of interest. But let's just say I do a 30-day, I just put it in there as a 30-day close, and that, you know, so that would be a 3/15 closing date, not really, because I don't even know what date it is. It's 5/3. So if I put a 6/3 on there as a closing date, then I'm going to have 28 days of interest. Yeah, because we have 31 days. So that interest, it adds up. So the other area for you to look, if someone says, well, I'm getting a better deal somewhere else, look at their loan estimate or look at their loan cost approximation and look at the interest that they have put in there. Because it might be that mine shows a little bit higher cash to close, but it's in the taxes, insurance, and interest. So you got to strip that stuff out in order to see really where the differences are. And then you've got all of the same information.